Hey, everybody, welcome back to another fantastic edition of the His and Her Money Show, where we make it our business to help you take dominion over your money and your life. And we are excited to do that yet again on this episode. Thank you for tuning in. You don't have to be here listening and watching us, but the fact that you are, we want to tell you thank you. We are grateful to have your ears and eyes with us because we want you to grow. We want you to become better. We want your situation to change in a positive direction. And that's why we keep bringing content like this to you every single week. If you haven't done so, please leave us an honest review on your favorite podcast platform so others can know that this show is good, because it is good. And we want to help as many people as we possibly can. Don't forget to keep up with us on our socials everywhere, every platform. Our handle is at His and Her Money, and we would love to engage with you there. Now, today's episode is going to be a good one because money is on the brain. We're at the top of a new year, and a lot of times we are in this part of the calendar trying to do things better than we did in the past. And this episode is going to help you do just that. We're glad that you're here. We hope that you got your pen and your paper ready, maybe even your iPad notes app open, because a lot of game is going to come your way from our special guest, Marc Russell. He's known as Better Wallet on the socials, and he's helping people do just that, make their wallets operate, function a little bit better than they have been in the past. So get ready. I'm going to go get Marc. He's going to give out game, and we want you to take note and take action. Hey, Marc, welcome to the His and Her Money Show.
How's it going? Thanks for having me on.
We're glad to have you here, sir. You've been doing great things online, helping people get their money situations together. So we're happy to bring you on to give a little more insight and depth on your wisdom so folks can get into a much better financial situation than they may currently be in right now. But there may be some people being introduced to you for the first time right here and right now. So for them, can you say hello and then just kind of let them know a little bit about what you're all about?
Absolutely. Yeah. So again, my name is Marc Russell, founder and owner of Better Wallet on Instagram, across a lot of different platforms, and the Better Wallet podcast. And really, the Better Wallet in general is all about helping people streamline their finances through budgeting, paying off debt, managing their expenses, in order for them to invest more. And then I also go a level deeper where I'm teaching people how to invest because of my background as a stockbroker, licensed stockbroker, and licensed financial advisor. And then the other part of it is not only building wealth, but how are you able to pass it on to your children tax efficiently. So that's really where my niche, if you want to call it that, that's where I focus a lot of my time and attention.
So you must come from money. I mean, you're talking about CFPs, and you said a whole lot of letters and degrees and finance. And I know from checking you out, you work for one of the major financial institutions in this world, one of our favorite, by the way. And people may assume that you had this from the crib, from the pacifier to the platform, Better Wallet, that you had this thing all figured out, man. Is that accurate?
No, not at all. Quite the opposite. I grew up, I'll start from the beginning. So I was born in Philadelphia, specifically Kensington. And if you look up Kensington, Philadelphia, and anything related to crime and drugs, that's really what a lot of it is. Unfortunately, both my biological parents, they were victims of drug abuse. So that made me somewhat of a drug baby, a crack baby, if you will. And my first couple days were in the NICU, where I was fighting for my life. And then, eventually put into foster care and went 13 years throughout the foster care system in Pennsylvania. And I was raised by I was eventually adopted by a family at the age of 13 that, they didn't have all too much money. You would think that, when you go through adoption care and you get adopted, you're probably going to get adopted by, Angelina Jolie and Brad Pitt, how they're adopting people, right? But it was quite the opposite. Small town, no one went off to college. Both my parents did not go off to college because they lost their parents early in their life, so they had to take care of their families because they were the oldest. And we struggled through the time that I was in high school, and even when I was in college. But we can get into that. But yeah, definitely don't come from money at all. Didn't know much about college. Didn't know anything about finances. And, no one, I was talking to someone the other day, we're talking about the topic of retirement. And I literally did not know anyone who was able to retire on purpose. most people they're able to retire because of maybe going to the military or physically disabled, so they couldn't work anymore, so they had to medically retire. But otherwise, the concept of putting money away and be able to retire on time was a foreign one.
Why do you think? Because this is literally the heart of what you do. Why is it important for anybody and everybody listening to put intentional effort behind understanding money to some degree? How did that pursuit change your situation, and why should we make that a priority in our own lives?
Because I believe that money is the ultimate freedom. I don't think money fixes everything, but it allows you to have options beyond the ones that you have. And being, coming from where I came from, where we didn't have money, and having to make certain decisions or live in certain areas because we didn't have that financial freedom, you have that ongoing stress that you have to deal with, because you can't move as you wish, or you can't make those financial decisions that you would hope to make in order to put yourself and your family in a better financial situation, or just a better situation in general. So money creates options, and then you're able to choose from those options, and then ultimately, really benefit both you and your family. So um, that's my whole thought process, and what I try to teach online is that I want people to put money away. I want people to pay off debt. I want them to invest, because then they can go and live the dream that they always wanted to live.
So, how'd you end up from the background, the tough upbringing, to situations that you had to go through as a child to working at Vanguard? Like, a lot had to happen for that journey to take place.
Yeah, the short answer is God, man. Like, God brought me through a lot. He was always by my side, even when I thought he wasn't. So that I'll start there. Second of all, a lot of hard work and dedication, a lot of tears, blood, literally blood, sweat, and tears. So when I applied to school, I had no clue how I was going to go and pay for it. But I said, hey, like, if I can get in, that's going to be the hard part. I can figure out how to pay for it through begging for money, negotiating, trying to sell the student aid office on what I bring to the table. So I did exactly that. So my freshman year, I came in. They said, "Hey, you owe $20,000 for this semester." I said, "Okay, well, I need to figure out how I'm going to go and pay for that." So a lot of my time was in the student aid office, asking for money, telling them my background. And that taught me a really important lesson as a young kid, that if I want something, I have to go and get it. Closed mouths don't get fed. So that was a very normal weekly occurrence of trying to, pay for school. A lot of grit, a lot of side jobs that I had to do. I mentioned blood, right? I had to sell plasma in order for me to, and like blood plasma, in order to put food on the table, in order to eat, pay for books and such. I didn't have a laptop. Back when everyone started getting laptops for college. I didn't have one. I had to go to um, the computer lab. I don't even know if they exist anymore, but in college they did. So it was a very interesting time, but my goal was to graduate within 4 years. As I mentioned, both my mom and my dad weren't able to go off to school because of the situations that they were in, losing their parents at one of the parents at a very young age. So my dad's goal for me was to graduate from college by any means possible. So I was there to make that happen. So after my freshman year, which was a tough one, I had well, not even okay GPA. I had a high enough GPA that I didn't get kicked out, but I owed $900 at the end of my spring semester, my freshman year, and that was enough for Penn State to say, "Well, you owe us $900. We're going to kick you out." So they kicked me out of school and had a fight to get back into school, which is a whole crazy process called a retroactive registration is what it's called, which if you look it up and you like look up retroactive registration in college, it's a crazy process where basically they take away all your student aid if you have any, and you have to pay out of pocket in order for you to get back into school. And then you have to beg literally everyone to accept you back. So I had to go through that entire process. That summer was a busy one, for sure. My uncle ended up passing away after finals, and then exactly 3 months later, after my uncle passed away, my dad passed away in my arms. So that was a very trying time. Going through foster care, I never had a father. That was the only father I had, and he happened to be my best friend. And that turned me from a boy to a man overnight. Just going through that and realizing I had to be the rock for my family. So, as mature as I was growing up, because I had to, I sophomore year was a complete game changer for me. So, sophomore year, junior year, senior year, I did everything I could in order to put myself through school. From being a resident assistant, where I had close to 40 to 50 students where I was directly responsible for them. They were all freshmen. So that gave me the leadership skills that I needed. And then managing my own finances, I had that component. I was helping people manage their finances as well. And also to put food on the table, I was helping small companies market their brand. So in State College, where Penn State's at, you have a lot of um, small businesses, and I was marketing for them. You put all that together, and when I was applying for school, and I happened to be an economics major as well. Or I'm sorry, when I was applying for companies, I happened to stumble on this company by the name of the Vanguard Group, and at first, I didn't know who the heck they were. Frankly, to be completely honest, their colors were the same colors of your shirt and your ring, black and red. So those are my favorite colors. I'm wearing black right now. So I said, wow, like I literally had I kid you not, I love their colors and it seems like they make money. And I went up and talked to them. And I talked to Gary, which is, still my mentor today. And we really hit it off. And from there, we went through 4 different interviews. For some reason, they flew me from State College to Philadelphia, which is only a 3-hour drive, but they did that and they put me in a black car. And from there, we went to campus, did the interview, and then next thing you know, they were giving me an offer. So, kid from the hood that went from foster care to being adopted to the small town to putting herself through college, and now I'm working for one of the largest mutual fund companies in the world that are like they're notorious for helping people, regular people, the everyday person, invest the right way. And Jack Bogle and the whole staff, they have been accredited for taking money from Wall Street firms and instead putting it in the pockets of the everyday person. They've won incredible awards over the years for that. And I'm just very grateful to join Vanguard and then also join one of their really prestigious programs called the Vanguard Accelerated Development Program, where they only choose 19 other people out of the country in order to join this program to eventually become a manager at the firm. So that was my experience at 22. And I just so happened to be with a bunch of other people, 19 other people that did not come from the same background that I came from. Let's put it that way. They're all private equity families. They had multiple homes. College wasn't hard for them. They're all Ivy League. And I'm coming in saying, like, most of my mentors growing up were entrepreneurs that did not pay taxes, if you know what I mean. So, it's just like a completely different mindset. But luckily, I was able to learn from them.
So I heard you say that one of the things you learned from your new job that you had at that time of your life was how to invest the right way. What's the right way? What's the wrong way? What do you mean by that?
Definitely. So back, if you look back to 2020, when people started to invest, and I'm really happy that people started getting into the market and starting to invest. A lot of people started investing into individual stocks, crypto, options, whatever it might be. It's been proven statistically that doing that strategy happens to be the most riskiest strategy that you can ever possibly do. If you look at just the risk spectrum, what I try to teach is more of the boring, or if you want to call it the lazy way of investing, where you invest into ETFs, exchange traded funds, and mutual funds, which happen to be what they call index funds, where you track the index. A lot of what I know about that comes from my time at Vanguard, which happened to be the place where mutual funds were built. and ETFs continue to thrive at Vanguard. So of course that's my background. But unfortunately, there's a lot of people online, and a lot of my clients that come in that say, "Hey, like I started investing and I lost a lot of money, plus 50% sometimes. I think it's too risky to start investing." But they don't know about this strategy, which happens to be boring. And if I post about mutual funds online right now, I'm not going to get a bunch of clicks, right? Not that much engagement. But what does get engagement happen to be the strategies that don't work over the long run. So that's why I preach a lot about the right way of going about investing, which happens to be broad diversification with ETFs, mutual funds. And if you want to have some stock exposure, make that a smaller percentage, but just building a really complete portfolio where you're diversified across the world is what I try to teach.
For me, I've observed the same thing that you observed. We've been doing this for 8 years. We've always been screaming index funds for 8 years, but as of late, there's more intrigue and interest, as you say, which is a good thing for people to want to invest. Some people have made it trendy, some people have made it cute. But I think there's this mentality. I think there's an attraction to the individual stock game. We have, for full disclosure, we have some individual stocks, but it's like literally 2% of our portfolio. But people pursue it, I think, because there's this sense of having one up. Oh, everybody don't know about this. Getting a hot stock tip. It seems exhilarating. There's this, pursuit of a chase, like you're going after the next hot thing. You know what I mean? How do I find out about Tesla before it becomes Tesla? And a lot of people post their wins, but they don't post their losses. So how do we fight through, the inundation? Because there's a lot of people prior to this current bear market who seemed like they couldn't miss on social media, right? Because you really couldn't miss because it was a bull market. But now you're finding out who is authentically on top of the game, which many of them aren't. But how do we fight through that messaging, right? And even that internal dopamine hit that comes with trying to find, that purple cow in the stock market, and just instead put our energy into the quote unquote boring index funds and ETFs?
Right. No, it's a really good question. A lot of what I try to do, so I'm a history nerd, so I love just studying history and how things are developed and why they're developed. And a lot of what I try to do is just teach the history of the stock market and backing that by proven stats, not necessarily from the Vanguards and Fidelities of the world, which, you can argue that they're going to come up with these stats because they want people to go into their ETFs and mutual funds, but backed by some of the groups out there like McKinsey and Bain and some of these other consulting firms that have information on what actually works and what doesn't. And for us, what we need to do and what we should continue to do is shift the perspective or shift the mindset of these newer investors that are just getting to the market. Because I'm not going to lie, like when I first started investing, I thought I could beat the market. I said, okay, well, I understand ETFs and mutual funds, like I feel like that's boring. I'm going to go after whatever the hot stock was at the time. And sometimes you have to get burnt in order for you to figure out what actually works and what doesn't. My motto is you have two different types of investors. You have one investor that believes that they can beat the market. And then the second investor used to be number one. And then they discovered ETFs and mutual funds and they started doing that. So you can choose how quickly you want to go through that progression. But likely at the end of the day, you'll settle on ETFs and mutual funds, but it might take you a little bit of time. So it's all about just teaching and changing that narrative on what works. And again, backing it by stats. And then from there, I think people will be able to make an educated decision on what they want to do. If they still choose to go after stocks and whatever the hot, investment play might be, so be it. But at least they know that it's an option. And then hopefully down the road, they can either teach a family member or a friend that, hey, like this actually works, but I choose to go this route. Or they would go and do the same thing, right? And the thing about it is like you just mentioned 2% of your portfolio happens to be in stocks. You can have the cake and eat it too, right? So you could have 98% into ETFs and mutual funds, and that could be the base of your portfolio, and historically that it's going to yield 7 to 10% annually over the long run. And then you can also have like that sweet tooth, right? Like I have a sweet tooth. Mine happens to be bigger than yours. 5% of my portfolio happens to be in either crypto or in individual stocks, because I do have a sweet tooth, and I know that I need to be in those vehicles for me to feel comfortable, along with ETFs and mutual funds. The way I compare it is, having Thanksgiving dinner, right? So if you're having Thanksgiving dinner or just dinner in general, and Big Mama's making the pie and the biscuits and whatever the pastry might be, and you roll in and you start eating the pie and the biscuits, and you don't eat the other stuff, the chicken, the turkey, the ham, the green beans, all that stuff, like the nutrients, the protein, and the vitamins. What's Big Mama going to say? You can't eat all that. You're going to get fat, right? Like that's not healthy. It's the same way with a portfolio. The vast majority of your portfolio should be what's healthy for you. And then, after you get done eating dinner, all of your dinner, you go off and you have the pie, you have the biscuits, you have the other things that, satisfy your sweet tooth. And that's the way that a portfolio should be constructed. Because if you do it the other way around, which unfortunately a lot of people did in 2020, 2021, I'm happy they got into the market, but they did it the wrong way. A lot of them are realizing that they have a very unhealthy portfolio, and now they're trying to basically make even riskier trades or riskier plays, how the cool people call it, plays, in order to make up for those losses. And a 50% loss, you need more than 50% in order to make that up. You need 100% to make that up statistically. So what we're trying to do, and I'm happy you're teaching it as well, is hopefully the newer investors that are coming in, have them try to avoid that mistake by being in ETFs and mutual funds, which rarely would you see ETFs and mutual funds not um, see ETFs and mutual funds lose more than 30%. It's extremely rare. But an individual stock, that happens all the time, especially with tech stocks that tend to be a little bit more volatile. Because it's really easy to bounce back from 15 to 17% loss, which we're seeing this year with ETFs and mutual funds, just because of how the market cycle has been working. But it's incredibly difficult to come back from a 30 to 50 or sometimes 80% loss in your portfolio. So my hope is that we're able to help people mitigate that, or not make that bad decision up front.
Imagine a life where your money isn't strangled by mortgage payments. Imagine what you could do when you don't have to send them money that you work so hard for. Come get simple, powerful, and real solutions to eliminating monthly mortgage payments forever. America's #1 money couple presents Crush My Mortgage. In this exclusive course, you will be equipped with strategies to help you move faster toward the promised land of owning your house free and clear. Learn strategies to help you in the areas of payment acceleration, extra income generation, and wealth creation, all to help you crush your mortgage. Visit crushmymortgage.com and get started today. Join us on the path to power, freedom, and legacy. That's crushmymortgage.com.
Yeah. Now, some people, they are reading the tea leaves, right? At the time of this recording, we're in a bear market, stock market wise. We are in a technical recession from an economic standpoint. We have inflation that's higher than in recent history. And some people are like, man, should I still be trying to invest in a time like this, or should I wait till things kind of cool off and kind of even out? What's your response to that question?
You want to buy the market when it's cheap. You want to buy at all times. You want to control what you can, but the best time to invest is when you have a bear market like this, because you end up buying into ETFs and mutual funds, or just the market in general, at a lower cost, which is going to help your returns into the future. Because instead of buying when things are incredibly expensive, like 2020 and 2021, you're buying them at a pretty significant discount, as I mentioned, like 17 to 20% as of today. So it's just something to look out for. But yeah, I mean, the way I compare it, I love using analogies because I think it helps people understand, market cycles and more complex topics. But I would compare it to, like, if you look out the window, I'm in Georgia right now, in Atlanta, and a lot of the trees have lost their leaves, right? So I'm not going to go down and chop down a tree assuming that the tree's dead, right? The tree's just dormant, and that's because of the cycle of our seasons. Where in the spring you'll see things bloom, and then the summertime it's going to be great, where the trees are green and the leaves are up and whatever, things are blossoming. But right now, in terms of the market, you're seeing exactly that. You're seeing the dormant time. You're seeing the fall, sometimes winter, of the market cycle, and that's completely normal. So I think a lot of people want to jump out the market right now, similar to wanting to chop down a tree when the tree is dormant, and that's what you shouldn't be doing. In terms of what people should be focused on is controlling what you can control. You can't control a lot of things out there. You can't control Atlanta traffic. Frankly, you can't control really any traffic at all. You can't control the market. You literally can't control it. So things that you can control your attitude. You can control how much you contribute to your investments, contribute to your accounts, and how often you do that. And then also asset allocation, which is a fancy term that means the balance between stocks, bonds, cash, and alternatives. So you can control all that stuff, but don't try to control the market. And what you'll see is that a lot of the people that understand how the market works, they're putting money into the market as much as they can. In fact, 2021 has been 2022 has been the best year, one of the best years for ETF cash flows out of all the years that the market has seen. And it's because people are seeing the opportunity and they're taking that extra money that they might have and putting it directly into the market. People are increasing their retirement contributions because they know that they're buying in at a discount. And then what happens when we see a bull market? We'll start looking, people show, oh, like I made these returns. The reason why they were able to make the returns that they made that might be higher than someone else's is based off of when they started to invest. People say all the time, millionaires are made in the bear market, not the bull market. So sure, it's exciting to invest during a bull market, and that's when a lot of people are talking about it. But it might seem a little counterintuitive, but you want to be investing when people aren't talking about it. People aren't talking about the market as much right now, but that's the best time to get into the market and see that appreciation over the long term.
Let's make sure everybody's on point with understanding the direction that you're taking us in. We've used terms like individual stock, mutual funds, index funds, and we talked about ETFs. Can you kind of give some basic definitions to each of those classes and help everybody differentiate the differences between them?
Definitely. So the individual stocks would be, the Amazons, the Apples of the world. Those happen to be larger corporations. You also have mid-sized corporations and then small corporations, what they call large cap, mid cap, and then small cap. Then when you look at ETFs and mutual funds, I'll kind of give the historical background before actually like describing what they are. But mutual funds came around because people would own those individual stocks. And then when something would happen negatively to an individual stock within their portfolio, they'll say, man, like mostly rich people will say, oh man, like I lost 50% of my portfolio because I'm invested into two different stocks. One did okay, and then the other one completely tanked. So they said, okay, well, is there a way that we could own more than, let's say, 500 different stocks in order to have that diversification without having to buy each one of those individually? So they created what we have now as being a mutual fund, where you own a lot with the market index funds, like the S&P 500 index fund. You own 500 plus different stocks that you can buy with a couple clicks of a button on the Fidelities and the Vanguards and the Charles Schwabs. the benefit of that is that you have that diversification. So if I'm buying in and something were to happen to Tesla because Elon Musk says something wild, I don't have to worry about that as much because that's only one out of 500 plus. So that's why mutual funds happen to be pretty popular. Just to kind of talk about mutual funds for a little bit. ETFs came around in the 90s. This guy by the name of Nate Most said, hey, like, what if we could have all the benefits of mutual funds, but allow them to perform and act like stocks, where stocks you can trade in and out pretty easily throughout the day. Mutual funds, you have to wait until 4 p.m. Eastern in order to figure out what price you get. Also, they wanted to find a way for these investments to be more tax efficient. Unfortunately, mutual funds tend not to be as tax efficient as ETFs. And then there's a whole host of other different benefits that you have with ETFs that you don't have with mutual funds, including the fact that ETFs tend to be cheaper. And I mentioned tax efficiency, and they also have much lower minimums. They're cheaper because of the tax nature of the ETFs. So people started gravitating more towards ETFs after the 2008, 2009 financial crisis, when people wanted everything to be cheap. And then you start seeing ETFs blow up. So literally every major firm has ETFs. And frankly, ETFs have become more popular than mutual funds over the years. So ETFs are nothing more but, I wish they called it mutual fund 2.0, because basically that, where they tend to be a little bit more efficient than a mutual fund. So that's what an individual stock is, what a mutual fund is, and what an ETF is, and how they all relate to each other.
Thank you for breaking that down. I'm sure everybody's a little more well-versed now than they were before. So you've been kind of opening eyes and kind of shaking the fog loose on the heart posture we should have, especially in the times like this. This is actually not a bad time to get involved. It's actually a good time to get involved. What are some of your rules of thumb when me as a new investor told me to get started? I'm wondering how to get started. Is there some companies better than other? What about these apps that's out here that everybody's talking about? Give us some insight on platform and just first thoughts if we're trying to do what you say and get involved and get our dollars in motion through investing in a time like this.
Definitely. Before starting to invest, just make sure you have your financial foundation set up. The foundation is extremely important, because I see a lot of people jumping in to investing, and maybe they don't have the money in order to invest, or they don't have emergency funds set up, right? So make sure you have a budget, or you have a spending plan in general. I know people tend not to like the word budget. I never like the word budget personally, but have a spending plan, know where your money is going, and make sure that where it's going is where you want it to go, based off your goals or your family goals. And then from there, allocate a portion of your budget to investing. So investing into, as we mentioned, ETFs, mutual funds. And then when you're thinking about where to invest, there's a lot of different options, but frankly, I don't gravitate towards those individual. I'm sorry, the apps out there. So I'm thinking Robinhood. There's a few others, and the reason why is I want to invest with companies that went through 2001 tech bubble, 2008 with the financial crisis, frankly, even COVID, because they've shown that they've learned from their, potential mistakes. They've learned from the market. They were able to withstand what was happening in the market, let it be people withdrawing money out like crazy. So you want that, because what happens is if you go into these newer platforms, like Robinhood is a perfect example. During COVID, when people are trying to take money out of the market, sometimes they'll say, hey, like, you can't take the money out. And that was their way of trying to avoid losing out on those dollars in order for them to stay alive, which is not good for the individual person. But the Fidelities and the Vanguards of the world, they say, hey, like, this is normal. Frankly, they probably even expected that was going to happen eventually. And they've done what they had to do since 2008 to make sure that their infrastructure was together in order for people to take the money out or reallocate, whatever it might be. So I think that's really important. when you are also thinking about firms that you want to invest with, these investment platforms, you also want a company where you can call in if you need some help. So luckily, when I first started in corporate America at Vanguard, when you would call in, let's say you want to talk about your 401k, I was that guy that you would call into, and I would help you manage your portfolio. If you had any questions, I was a licensed representative where I can talk to you about literally anything related to investing. If you try to call Fidelity right now, I did it a couple weeks ago. If you try to call them, they now have the not Fidelity, Robinhood. If you try to call them, you actually have to submit a ticket, and then they will call you back. And when I did that 2 weeks ago, they told me that they wouldn't be able to call me back for another like 3 or 4 days. Like, who wants to wait 3 or 4 days to get their problem taken care of? But at Vanguard, they have a whole staff of people that you can call, and they'll be able to answer your question. And it's not just going to be some operational person; it's going to be someone who has answered this question 1,012 times. So I think that's really critical. So in terms of firms to look for, that's what I look for. And if you're trying to get even more specific than that, I look for platforms that have a really intuitive and straightforward platform. So for example, you would think that I'm biased towards Vanguard because I work there. I'm not. I actually don't really like their technology as much. And unfortunately, I know a lot about what happens in the background in those meeting rooms when they're talking about technology. So I don't use them. I use their funds, but ever since I left Vanguard, I've used Fidelity. And I love their platform. I think it's straightforward. I love their app. And it seems like they take feedback and they implement it pretty quickly. So that would be, I'm not paid by Fidelity or anything like that. I just really like what they do. So that would be my guidance for anyone looking to jump into the market and how to go about doing it.
Now you said it starts with a couple of things: budgeting and an emergency fund. And so you said create a line item in the spending plan that's geared toward investing. And some people are like, well, okay, well, how do I go about that? I've heard this percentage. I've heard this dollar amount. That should be 5%. It should be 10%. It should be 15%. Heck, you should try to get up to half your income. So what is the better wallet recommendation if I'm trying to figure out what's a good number for me to start sticking into an investment into the stock market? How do I evaluate that?
Definitely. So a lot of times people go and they start with, hey, like I need to have a certain percentage, as you mentioned, like 5, 15% is like what I hear being thrown around. What it comes down to is what specific goal you have. So you want to invest based off of your goals, not based off of what other people are doing, or what percentages they might recommend. So my percentage for investing might be different if I have kids or if I want to retire early, whatever. And 15% might not be good enough if I'm looking to retire in the next 10 years, through FIRE, like retiring early. So you want to figure out what that goal is. And I'll use the example of, retiring early. Let's say in 10 years, you want to retire with $1 million portfolio. From there, you want to work backwards. And you say, okay, well, if I want to retire with $1 million portfolio, you can simply put the numbers that you're assuming into a basic investment calculator. So if you go to an investment calculator, Google investment calculator, you can go and plug in those numbers, and then you can back into how much you should be investing on a monthly or annual basis in order to meet that specific goal. You can replace that FIRE number, that $1 million number in 10 years with literally any goal that you might have, whether it be, investing for your child's education through a 529 or using a UTMA, or even if you want to retire at 59 and a half and you say, hey, like I love my job and I want to take the traditional route, or you want to buy a car or a boat, whatever. And that's how you go about doing it. So you might back into having to invest $100 per month. You might back into it. It might be 1,000, but it all depends on what that end goal is, and what goals you have for you and for your family.
Well, the good news is people don't have to figure everything about this money journey out on their own. You created an amazing course to help people walk from start to finish and get their finances in check. If people go to hisandhermoney.com/better wallet, they'll find out what you have to offer. But can you kind of explain a little bit more about your program and how you are helping people get on top of the game financially?
Absolutely. So one of the reasons on why I wanted to create the course, or even when, why Better Wallet started in the first place, is that I found myself, at the age of 30, at a point where I felt like I was making millionaires, multimillionaires, but I wasn't helping my own people invest their first $10,000, first, six figures, first $1 million. So at that inflection point, I said, well, once I'm done with corporate America, and I have a little bit more time, I'm going to create a comprehensive course where I'm going to teach everyone what I know from being a licensed stockbroker, financial advisor, and then also kind of going through the school of hard knocks where I had to manage my own money, paid off $8,000 of debt, learn how to budget, learn how to invest and build my own portfolio. I'm going to teach them all of that and some. So the day that I quit corporate America, about this time last year, I started working on this course. And as I mentioned, I put my all into it. So the course teaches you how to go about streamlining your money so you can invest more into ETFs and mutual funds. And then also, if you want to get into individual stocks, I talk to you about my investment strategy. And I just don't talk about, hey, like, here's how to budget and then here's how to invest into ETFs and mutual funds. I talk about the different tax strategies that are out there. I talk about, I mentioned a little bit about 529s and UTMAs. How do you go about investing for your kids? And then also retirement plans. So a lot of times when we start in corporate America, we are handed this packet from benefits during orientation. They say, okay, read this and learn everything you need to know about your benefits at X, Y, and Z corporation. Who's reading that? No one's reading that. Like, I'm going to go and focus on my role and not read this packet of information. So I teach everyone what benefits to look out for, why it might advantage you and your family. And then the icing on the cake is the last module, the last of the core modules. I teach you the tax code. So I teach you basically going through a form 1040, which is a form you fill out for an individual tax filer. I go through that line by line and tell you, hey, like, here's some of the tax benefits that you could take advantage of. And here's how you go about taking advantage of them. So it's a comprehensive course teaching how to streamline your money, how to invest, not only for you, but also for your kids, building bonus modules as we go. The last one I just did is focused on how you can go about negotiating your salary. And that's with Mandy from Brown Ambition. So I was really excited to get that onto the platform. But the goal is for it to be the most comprehensive program out there if you're really serious about getting your finances in order.
So again, you can go to hisandhermoney.com/better wallet and you can sign up right away. Listen, you don't have to try to MacGyver and paperclip and duct tape this journey together. Marc has put together a very comprehensive course to take you from start to finish. So you kind of are without an excuse. Invest in yourself, invest in your future, so that this time next year, you're sitting in a much better place financially than you're sitting right now. Again, you can go to hisandhermoney.com/better wallet for more details. Marc, before we get out of here and I let you go, give us a mentality and mindset adjustment that we need to make. Sometimes we get comfortable in career progression. Maybe things are doing good. I've got more money coming in than I've got bills. I got a little bit of savings. I got nice cars outside. I'm in a nice neighborhood. My kids go to a nice school. That all breeds a place of complacency. And especially for people that look like us, we don't necessarily have the tools until now, till they listen to this episode, to think beyond just being okay financially. Help us to move into a mentality of wealth accumulation, and why this is a mindset that we need to execute in this new year.
Yeah, I'll start by saying that, specifically for our people, we are the dream and the wish of the slave, right? Where we're at today is light years beyond where our ancestors probably would have thought that we will ever be. And you can use that and say, well, I'm going to live in the now and I'm going to just pay for things that are in the present. or you can focus on how can we continue to build on this in the future. I mean, if you look at the stats between, our folks and, other demographics, we happen to be significantly behind them in terms of net worth. I mean, really any category. So we need to actively find ways to close that wealth gap. And that's through investing. It's through voting. It's through getting into real estate and trying to find a way to boost your net worth and find a way to limit how many liabilities we have and instead focus on assets and what Beyonce says, pay me in equity, right? So focus on equity instead of liabilities. So that's really the mindset that I'm in. It's not only how can I live in the now and have my fun with whatever success I might have, but also how can I make sure my kids are taken care of and my great grandchildren are taken care of? Because I want to be the families out there, like the Walton family, where if you have the last name of Walton, you probably won't have to work another day in your life because of how their dynasty trust is set up, right? So like continue to educate yourself, continue to find ways to live in the present, and then also invest for the future. That way we can continue to close that wealth gap and we can, make sure our future generations have hammocks in their family tree instead of how we had to come up.
Good stuff, man. Now, people are going to want to keep up with you on social media if they're not already doing so. So where can they find you?
Absolutely. So you can find me at Better Wallet, BetterWallet on Instagram, also on TikTok. I'm trying to build that up as much as I can. I'm not the dancing type, but I'm trying to build that up. Twitter as well. So across all platforms. And also I have the Better Wallet podcast, so you can tune in there as well, where we're talking a lot about these same topics. And if you follow me on Instagram, I always have the rule: send me a DM, tell me where you're coming from. My mama always said, like, don't come into the house and not greet the person who lives there. So come in, send me a DM. I answer all my DMs, and let's connect and talk about what your financial goals might be.
All right. We'll be sure to have everything that Marc mentioned in the show notes of this episode. So you can find his course, you can find his handles and everything that you need to know in order to get your wallet operating a little bit better. Marc, thank you so much for taking time out of your busy schedule to come and share your wisdom with us today.
Yes, sir. Thanks for having me on.
There you have it, ladies and gentlemen. Another fantastic edition of the His and Her Money Show is in the books. Hope you took good notes, and I hope you're ready to take even better action. Again, everything we mentioned you can find in the show notes. If you're watching us on YouTube, look right underneath the video in the description box. You'll find everything there. If you're on the podcast app, you can just scroll up and you'll find all the information in the show notes. And don't forget, we have more and more and more education and inspiration just like this over at our website, hisandhermoney.com. That's all we got for this time, guys. It's been great. Till next time. Peace.